Riocan is one of Canada's top real estate investment trusts, and it posted earnings this week. I'm going to take a look at how it did, what the key numbers were from the earnings report, and whether it's a good buy right now. The stock yield is nearly 7%, but is it a risky dividend to rely on, or could it be an underrated investment for your tax-free savings account? Let's find out. In Q1, Riocan had a $209 million write-down due to its joint venture with HBC. As a result, the company posted a net loss of more than $84 million. However, occupancy levels are at record highs at around 98%, and the company's blended leasing spread is 17.5%. That represents how much higher its new rental rates are versus expiring ones. The higher the number, the better it generally is for a REIT, as it signifies strong demand. And its funds from operations, or FFO per unit, came in at 49 cents this past quarter. That's an improvement from 45 cents in the same period last year. If you're unfamiliar with FFO, it's simply an adjusted earnings calculation which REITs use to determine how well they're doing, and it's used to gauge how much they can afford to pay in dividends. This year, the company is adjusting its FFO guidance. It expects FFO per unit between 1.85 and 1.88. That's down from a previous forecast of 1.89 to 1.92. The reason for that adjustment is due to that joint venture with HBC. But despite this, the dividend still looks to be safe. The company estimates that based on its FFO, its payout ratio will be around 62%, and that's well within its long-term target, which is a range of 55% to 65%, and the REIT's payout ratio is relatively low when compared to its peers. For dividend investors, the sustainability and safety of that payout is critical, because one of the big reasons to invest in Riocan today is for its dividend. Currently, the REIT pays investors a monthly dividend of 9.65 cents per unit, $1.16 over the course of an entire year, which translates into a yield of about 6.8%. That's a fairly high yield. The S&P 500 average is around just 1.4%, and if you're collecting a 6.8% yield, you can generate a lot of dividend income on a modestly sized investment. For example, if you invested $15,000 into Riocan, you'd be collecting more than $1,000 per year in dividends. But with the average S&P 500 stock, where the yield is only 1.4%, then your dividend income would only total $210. That's why a high-yielding stock, especially one whose payout is safe, can be extremely valuable. And don't forget, if you've got a tax-free savings account and put an investment in Riocan there, then all that dividend income is also tax-free. That's why this can be an ideal stock to put into a TFSA for all that great tax-free dividend income you can accumulate over the years. This year, shares of Riocan are down around 6%, but over the past 5 years, the stock has risen by more than 15%. While the returns haven't been amazing, and it likely won't take off all of a sudden, the main reason to really invest in the stock is for that high yield. If you just want to collect a good dividend, this can be the stock to own. What's appealing about Riocan's business is that it has a broad portfolio of assets, including 177 properties. Riocan's focus on being in urban centers and major Canadian markets also makes it less risky of a buy than other REITs, as those are areas which are likely to do better than the rest of the country. It's in areas where the population is both dense and where household incomes are high. Its tenants are also some of the biggest retailers in Canada, including Loblaw, Canadian Tire, Dollarama, Winners, and many others. These are stable businesses to rely on, which is why Riocan can be a dependable investment to hang on to for the long term. While there is some near-term risk due to tariffs and the ongoing trade war with the US, and there is also the possibility of a recession being on the horizon, which could spell bad news for many big-name retailers which Riocan relies on, but with a diverse portfolio, it's still one of the safer REITs to own on the TSX today. And even if there may be some risk in the short term, just like with COVID, it'll recover and continue to be a good buy in the long term. Overall, this is definitely a stock I think you should consider buying right now. So what do you think about Riocan? Is it a good buy, or do you prefer other REITs or dividend stocks instead? Leave a comment to let me know. And if you like this video, please leave a like and make sure to subscribe for more videos like this. Thanks for watching.